Hello YouTubers, welcome to the Independent Investor. Over the last week I decided to sell a few shares, which I'll mention later, and kept most of it in cash with the coronavirus in China and uncertainty, the ongoing proceedings with the impeachment of Donald Trump, and Friday having a relatively bad day that might carry through into next week. I thought I'd just leave a bit of cash, and returns have been pretty good over the last year or so. But I did come across one growth stock, selling it a reasonable value, and I picked up some shares. That company is, you can see in the chart behind me, is Trinet, which the symbol is TNET on the NASDAQ. It's basically a human resources company for what's called SMBs, which is small, medium businesses. Basically businesses that maybe have 100 employees or maybe only 10 employees that want to provide benefits for their employees, such as healthcare and other services. They can't really afford to set that up on their own. It's just not cost effective. So Trinet does that. It also supplies a lot of other services, such as payroll, basically all HR roles it does play. And they have kind of a different model. It's not like a lot of the cloud models where a lot of this is done kind of in the cloud and the company then just accesses it through a terminal. They do what they call a WSE, which is a worksite employee. So one of their employees is actually at their client or the company which they're providing the service to, and that allows direct personal contact. They've been around for a couple years now, maybe getting close to a decade, and they've grown fairly consistently. They also have other vertical plans, approaches for different industries too. So they do life sciences, they do financial, they do nonprofit, and they call what they call the Main Street Bundle. That's for retail, hospitality, and property management. And this captures all the different types of taxes incorporated in these businesses and specializes taking that workload off the company. There's a fair bit of competition in this area, and this segment is called Professional Employee Organizations, or PEOs, but there's actually fairly small penetration. Only 6% of businesses, say with 100 employees, use this type of service. So there is room for a lot of growth, and they should be able to continue to grow as I show. They've been growing about 10-11% each year pretty consistently. So the valuation still a little bit on the high side, so I'll kind of explain what I did to hopefully bring that down a little bit. Also, if the company continues to grow at 10-11%, then it should kind of grow out of the over valuation. And compared to a lot of companies in this field, in the technology area, it's actually priced relative to them pretty reasonably. That's why I decided to buy. It's next to impossible for me now to find anything in technology that I'd want to purchase for a long term. They provide their service online and for their employees, and also also through mobile devices, so the employees can look at their benefits, their pay, all that type of through their smartphones. They have 332 worksite employees, so they are quite large. They're one of the larger firms in this business, and they have about 16,000 clients, and they have a good retention rate with these clients, so that helps bring the cost down. There's not a lot of churn. Of course, there's a lot of upfront costs when they get a new employee, setting up the contracts and the IT and everything to go with their service. So, so what I did with this company, we'll go kind of towards the daily technicals. It did reach a high of 77, and we came all the way down to 50. I picked this company up around 55, 56. And I did notice a gap back earlier last year, and surprisingly, or not surprisingly, the company came down, filled that gap, and then turned around. And that's not unusual. It's always good to, if you buy a stock, look back in the charts for any gaps, because 9 times out of 10 the price, for whatever reason, will come down and fill that gap and turn around. And there wasn't really, I couldn't really find a big reason for this correction from 77 down to 50, 51. I think it was mostly because it got slightly overvalued. So now that gap has been filled, and there's been showing a pretty good upturn since then. It also filled this small gap here, and then did correct back down, but that was when the news came out of China about the coronavirus. So I'm not buying any more now, just because of the present uncertainty, but this is one I hope to keep and not trade, but to bring down my price through option strategies. So what I did, because like I say, the company is not really cheap, but one of the better, I think, values you can find in a growth company right now. I did a covered call at $250 out to June, so $65 covered call, meaning I'd have to give up the shares at $65, and for that I received $2.50. So you can look at that as a dividend, or you can look that I actually lowered my price by $2.50. And if you can do that maybe 2 or 3 times a year, then you've slowly bringing your price down. I also did a short put down at $1.60 at 45, because I feel this company got down at $45. I'd have no problem taking somebody's shares at that price, and I got $1.60 premium. That's per contract. One contract's 100 shares, so it's $160. So I will continue doing that. I don't mind if my shares get taken away at $65 or $70 range. To me, it's almost a bit of insurance that I'm not holding stocks that are grossly overvalued. And but it's far enough away. If you look at the delta on an option, that can be equated to the percentage chance that it will be taken away. And I think the delta was like 0.2 or something around there, so maybe there's about a 20% chance of that being taken away. But it's just one way of kind of holding a more overvalued stock than what you normally would, and creating a bit of income out of it. And so I did that, and then bear with me and I'll show the weekly chart. The company basically had an IPO back in 2014, had a strong rally and then a real big correction. Went down to $12, and then you can see it had another correction, but did run all the way up to 76. This sell-off here is comparable to the last two in size, and typically it recovered pretty strongly after that. So that was my reason for purchasing it. And it does help a bit with diversification too, because as I've mentioned in past videos, I have a lot of companies now, dividends, and a lot of those end up being in utilities. So I have a lot of pipelines and electricity producers and that type of thing. So this does give me some more diversity in my portfolio. I went through the spreadsheet on this. I spent a day or so just going through all the numbers. Its retained earnings are still negative, meaning that they haven't really made any money yet, but it's a new company. But the deficit has been decreasing year by year by quite a amount. As I've shown here, in 2016, revenues were about 3 billion. They're up to about 3.5 now. So again, about a 7% return. Not too much. It isn't overly debted. I'm always concerned with new companies, especially in the technology kind of field, that they get carried away with stock options.